Good evening. I said good evening to everybody.
Good evening.
All right, the guy with the pen, you can't speak and write at the same time?
Good evening.
All right, it's much better. Here we go, all right? So, and you're new too, right?
Yes.
So let me set some rules. My name is Steve Young, so I want to welcome you. And I'm just going to open up the meeting by saying, listen, if you got cell phones, please mute them because we want your undivided attention. How about that? Because you're here for one of two reasons. People invited you just to check out an opportunity because they truly would like your opinion and have you evaluate this from two perspectives. First of all, I got to ask you all a question. Is there anybody in this room, and please be blatantly, candidly honest, because that's all you're going to get today is the truth about how things work, and you're going to be in a state of shock, all of you. I don't care where you come from or what you do for a living now. You're going to learn things that you should have been taught way back in grammar school and never had, and you're going to find out what a dramatic difference it makes in your life for not having known it right now. So who in this room, here's my question to you, who in this room is financially independent now? Is anybody financially independent here? Good. You're financially independent? Okay, good. And so do you have a few million in the bank, or how are you?
17.
17 million?
Yeah.
That's good. You know you're never going to get out of here alive. You understand that? And we got maniacs here to beat you to death for lying. No, okay. So that was very good. He goes, hey. No, but don't you wish you had 17 million? Did somebody else raise their hand? Somebody else said they're... Because if that's the case, then all of you need to pay attention because all of you need the services that we're talking about tonight. That's the first thing. Because I normally just say you're either here for one of two reasons, the service or the opportunity. Every one of you need to implement what we're showing you tonight or stay broke and like it. How about that? Does everybody get that message? Because it's all about money. How many of you know you need money? Okay, so you might as well, most of you work for money. Am I right or right?
Right.
Isn't that sickening? You got to get up and go to work whether you like it or not. Is that true or true? See, not all of us in this room do what you do. You roll out, some of us roll over. How many of you like the rollover plan? You all get that, right? Some of you would like the rollover. So here I'm showing you that there's a business opportunity. Now, for all of you brains that are not that are closed-minded, you got to open it up today. Because here's what you do. Because I know I do it. And if I'm doing it, you do it too. Because we're all alike. You know, you limit your thinking, and I call that stinking thinking. How many people agree with that mindset? See, you cannot be in this room tonight and say the word can't. If you do, we give you a free beating. How many people allow us to give you a free beating? Great, we don't charge, okay? Well, so no, Dadey doesn't like that at all. He goes, no, I don't want that free beating. So we're going to educate you about that. We're going to introduce several speakers to you, and you're going to learn about the concepts and the company, and we're going to throw a lot of information at you. So if you want a notepad, you should get one because you're going to learn a lot. It's not overload. You're not expected to know everything. We're just giving you the gist of it. Are we going to explain everything in details? No. We don't have to. We don't have the time. Okay? But you'll certainly get the concept and the understanding. And it's pretty much fun. You'll hear about all the history of the company very briefly, and then we'll stay behind afterwards and answer any questions for you. Is that fair enough?
Yeah.
So without any further ado, just to give an orientation on the company, we have our first speaker, and you're going to see several of them tonight. And then if you please welcome up Byron to give an orientation. Byron Firestone, he has nothing to do with the tires.
Small bit, but no money related. Welcome everybody. So as Steve said, it was a great introduction for me, but we are Empower Financial, and we are here, as he said, for one of two reasons, business opportunity or also for the services, and he made it very clear that if you're not financially independent, pay close attention. So there's 4 branches to our business, and if you look up at the screen here, this is our website, Empower Financial, and we will go right here. We are a consumer advocacy group. Does anybody know what consumer advocacy means? Paul.
A company that's looking out for the best interest of the consumer.
Yes. So what we look out for the best interest in the consumer. We look out for the best interests in you, me, everybody in here. Anyone that goes to the store, anyone that works for money, we look out for the best interests of you. Who in here uses electric? Okay. You don't use electric? Sir? What's your name?
I'm sorry.
It's okay. I didn't hear right. What's your name?
Dayton.
Dayton. Byron. Nice to meet you. Dayton. So when you get your electric bill, what do you do?
Look at it and pay it.
There you go. Who else does that in here? Pretty much everybody, right? Why is that? Because down here in Florida, it's electric is not deregulated. And what that means is, Garrett, is it FP&L that's our?
Yeah.
FP&L is the electric company down here. It's a monopoly. A monopoly means that they own the entire industry of that part, and you can't really do much about it because there's no competition. So you open it up and you pay it, right? What if you had a choice to shop around, such as grocery shopping? You know, you go to Walmart for a lower price, or you go to Whole Foods for the better quality. Would you like that? Yeah?
Yeah.
Okay. So what we do, and it's we work with a company called Utility Advocate, and then there's 14 deregulated states for electric. What that means is we can go in there into a person's house and show them, hey, if you would rather have this electric company or if you would rather have these services, we can give you options. And more times than not, you'll save money. And to be honest with you, it's probably right now it's the most growing, as in the fact that there's only 14 states in the United States that are deregulated. But I think, Steve, is Florida one that's starting to become more?
Not yet.
Not yet, but okay. Well, unfortunately, Florida's not. But in any of those 14 states, you can go into someone's house and say, listen, we can show you more options. You have more than just this. You don't have to just open it up and pay it. If you want to save money, you can go to, you can try this service. Or if you want better quality, you can try this service. So that's one part of our business. The second part, if you are a business owner in here, you're going to love this. It's called business auditing. When you own a business, you have to swipe credit cards. People pay with credit cards. That's called a merchant account. You're paying a service to a company, usually 3 to 5% for that service, which kind of stinks, but someone has to run that service. Also for your telecom services, your telephone, your internet, your cable, we can go back into those companies and audit them and find out if you've ever been misbilled, overcharged, or even if there's been a better rate out that you weren't explained or offered. For example, if, Mike, let's say you're paying a company $50 a month, okay, for a merchant account. If they, for 1 month, ran a special and said, hey, you know what, we're going to give you $30 this month, you think they're going to call you up and say, hey, by the way, you got a $20 refund check? Probably not, right? So we go in dating back to 2 years, whether if you've ever been misbilled, overcharged, or if you've ever had a better offer that could have been offered to you. And we go and save money for the future years to come. By the way, that analysis to have done is free. And you get paid on it if you're in the business to do that. So that's the second part of our business. The third part, one of my most favorite, debt. Who in here is in debt? I'm in debt. I'll be the first one to say that I'm in debt. I went to college. I have college student loans. One day I'm going to pull out a mortgage. I'm going to have a mortgage. Okay? We have a debt program that, without using any more money out of pocket, you'll pay off your debt quickly in the most efficient way possible, just using algorithms. And what's really neat about this debt program is, there's no ladies in here, so I can't use my usual example, but Mike, I brought you today, so I'm going to pick on you. Mike, after this meeting today, we're going to go out and have a couple beers, maybe have dinner. You tell me I'm a great speaker, so you're going to buy my dinner for me tonight, okay? You're in the debt program. You put all your debt in, all your information, whatever's in there. We show you the most efficient and easiest way to pay it off. Now, what's really great about that is with our debt program, it works as a GPS system to life. And what do I mean by that? Anyone in here use GPS for traveling around? Yeah. If you're in a place you don't know, when it says turn left, if there's a road there, you turn left, right? Because it knows the best and fastest way to get to the place you're going, which in this case, it's debt-free. It's a GPS system of life, as in the fact that if you take me out to dinner tonight and you swipe your card for $70, because I bought a steak, sorry, you're going to, right in that moment, that $70 on that credit card is going to go into your debt program and show you exactly what that is doing to your debt this moment in time, and now what you need to do to take steps forward to pay that, to get out of that situation. So it leads you how to live your life debt-free, because debt is the thing, when you get paid, debt is what you got to pay off first. Because if you're making money and you're not paying yourself first, you're paying off debt. You're paying someone else. And that stinks. So that's the third part of our business. The fourth part, so now we've saved money on electric. We've saved money on your business if you're a business owner. We've got you debt-free. What do? Retire. Yeah. Well, that's pretty easy. You saw it up there, retirement, right? You pay yourself, though. Steve always says, and I love the saying that he says, is is when he learned the fact that you should pay yourself first, he took that concept to heart. He would always pay himself first. There was days that he tells us that he was back on rent, but he would always pay himself first, because who's the most important person in your life? Yourself. You're the one that goes out, you pay the bills, you're the one that makes the money yourself. Now, obviously, family's very close, but how are you going to support your family if you don't have yourself there, right? Exactly. So we give you a way to pay yourself first, and not only pay yourself first, but to have a way to get yourself tax-free income, to pay yourself first. And you'll learn more about that as we go. But before you go into any of this, you need to know how money works, because if you don't know how money works, you're already behind. Because what you don't know is what you don't know, and what you don't know is going to keep you broke. So the first lesson of learning how to pay yourself first is learning how money works. And learning how money works is to learn how money doubles. And I'm going to bring up Garrett now to show you the Rule of 72, which was a math equation invented by a great man named Albert Einstein. So Garrett, if you'd like to come up here and do the Rule 72.
Well, guys, most of you know me here. My name's Garrett, and for the new guys, just met you. Thanks for coming in. Basically, what I'm going to do is a little thing. It's something I saw back in Steve Young's office when I was a young chap. I was about 16 years old, and it's out there. It was called the Rule of 72, and it's simply put, it's just a compound effect of how money doubles. And what you do in order to ever calculate this out, you can use any interest rate that you have. So any interest rate you have at all, whether it be a mortgage, credit card, student loan, any kind of like retirement plan, if you're getting a certain percentage rate of return, you can divide that into 72, and it's going to show you how long it's going to take for that money to actually double on top of itself. So we're just going to run through a quick little example. So say we have somebody age of 23. Is anybody 23 in here, by the way? Back there, we got Andrew, Byron. How old are you, Mike? 22, so pretty close. And so let's say you guys had $5,000 you wanted to put somewhere, right? So you say you had $5,000, you wanted to invest somewhere, and so where do most people go? Say you get a check of $5,000, where would you go put it? To the bank. You would say, what would you say? Savings account, right? In a bank. So you go to savings account, right? And the average, does anybody know the average rate of return on a savings account currently, right now? Byron?
0.3%.
Yeah, it varies between 0.2 to 0.5. So maybe in a long-term CD, you go take it, maybe you get a 2% rate of return. So for this example, we're going to say, all right, say we wanted to invest our money. We had $5,000. We wanted to go put it somewhere. And where we're going to put it is that they're going to have a 2% rate of return. Say it's a long-term CD. They're going to give you 2% return rate on your money. And you wanted to see how long it's going to take for that $5,000 to double on top of itself. Well, it's simple. You take 72 divided by 2%, the rate of return, and it's going to equal 36 years. 72 divided by 2, it's going to equal 36. That's how long it's going to take your $5,000 to double on top of itself, right? So you just do the math. 23-year-old's got $5,000. It's going to double every 36 years because you're getting 2% rate of return. So if you add 36 to 23, you're at 59. There's 10,000, and then at the age of 95, it doubles again, so you're at 20,000. And for that, I go woohoo, because at the age of 95, getting only 2%. Is $20,000 really going to be anything to retire on? Is it really going to be? Who knows what's going to happen by the time we're all 95 years old, where we're going to be in the world today, and what $20,000 will actually buy you? Hopefully more than a stick of gum, but we don't know. So let's say that if you had 2%, you got it every 36 years. Let's say I felt bad. I opened up a bank. Okay, so Mike, you came to my bank and say, you know what? I feel bad at 2%. 20,000 is not going to give you a whole lot, right? So let's say I'm going to give you a better rate of return. Say I'm going to give you 6%. Because I feel bad. You know what? I think you're a savvy guy, and I'm going to buy you a new laptop as well. So to come to my bank, you're going to get 6%. I'm going to give you a new laptop, and I'm going to give you 6% rate of return. So if you take 72 divided by 6, it's going to equal every 12 years. Now, you're the same guy, 23-year-old. You got $5,000, but you're going to come to my bank because I'm going to give you a nice laptop and 6%. Now, what do you think you might have, Mike, at the age of 95? Down there in the middle, as opposed to 95 at 2%, now you're at 6%. So I tripled the interest rate, and I cut the time down by a third. So instead of every 36 years, you go 12 years. What do you think you might have at 95 at 6%? You have 20,000 there at 95 at 2%. You can take a wild guess. I know you don't know it. But 60,000? Sounds good. What about Andrew? You, Andrew.
180.
180? Sounds good. Marsh, what do you think?
I don't know.
Throw it out there, man.
I think like 120.
120? Sounds good. Well, let's go ahead and let's play it out. So all we did is just cut, we added 4% higher. So we cut the time down by a third and triple interest rate. So the same guy, same 23-year-old, save $5,000. Let's see what it does at 6%. So 23, you're going to add 12 to that. You're at the age of 35. There's 10,000. Another 12 years goes down. You're at the age of 47. Now you're at 20,000, which is way better than 95 at 2%, right? So let's do another 12 years. Age of 59, sitting at 40,000. Another 12 years go by. You're at the age of 71. There's 80,000. So see you later, Mike. Another 12 years go by. You're at 83. You're at 160,000. So see you guys back there. And finally, at the age of 95, you're sitting at $320,000 with the same $5,000 at 6% as opposed to 2%. It's pretty cool, right? So thank you guys for coming to throw me your money in my bank, because I'll give you your 180, I'll give you your 120,000, I'll give you your 60,000, and I'm still going to always make money off each one of you, right? And you'll get your laptops by the way, so don't worry. But let's go with something a little bit more realistic. So let's say you wanted to invest money, you want to invest it in the best rate of return possible. So let's say we're going to give you 8%. It's a little bit more realistic. The average stock market in the last 20 years has been a little over 9. So we're going to show 8% though. So with this example, we're just going to go 2% higher. So instead of going 6, we're going to 8. And we're cutting time down by 3 years only. So I'm only going 2 points higher in 3 years doubling periods difference. And I'm going to ask you guys again, Mike, what do you think you might have at 95 this time? Just only 2% higher though. 700,000 sounds good. Andrew?
2.1 million.
2.1. You jumped up on that one, didn't you? Marsh, what do you think?
1.4.
1.4. All right, well, let's go and play it out. So same guy, same 23-year-old, same $5,000, and so we're just going to go and play it down the line. So here we go. 9 years. You're at 10,000. Another 9 years later, 20,000, which is opposed to 95 there on 2% on the left side. Only 6 years difference from the 6% to 8%. But let's see how it plays out in the long run. So another 9 years down the road, you're at the age of 50, you're at 40,000. Another 9 years down the road, $80,000. 9 years later, you're at the age of 68, you have 160,000. Another 9 years, you're at the age of 77, which is 320,000 as opposed to 95 there, 6%. Another 9 years down the road, 640, and finally, at the end, you're 1.2, 80,000 left over. So with the same 5,000, you can see the difference of just 6% as opposed to just 8%, really what the compound effect of money is on just 2% higher, right? So because it cuts the time down by 3 years, but that 3 years really makes it long run just because of how compounding interest works. So basically on this, I like to ask the question. We have A on the left, B on the right. Dude, if you had a choice, which one would you choose? You got A on the left and B on the right.
B on the right.
B on the right, of course, man. Everyone would go for it. Mike, I'm sure you would say the same thing. If you had a choice between 20,000 or 128, 1.2 million, which one would you choose? Of course, it's going to be the one on the right. Now, the biggest thing about this is that we like to call this legalized extortion. Now, extortion means theft. And why do we say that? Well, if you're going to go put your money, the majority of people put their money in the bank. I have a bank account. I have a savings account. Put my money in there. And a lot of people use savings accounts as ways to build towards the future. Well, we already said that savings accounts give you, on average, 0.2 to 0.5. So if you were to take 0.2%, divide it into 72, it's going to take, 140 years for that to double on top of itself? It's not really an efficient way to do it. But what's happening is that when you're putting your money in that savings account, the bank is actually taking it and they're investing in that 8%. Which means that even if we're going to show 2%, say you had a long-term CD of 2%, they're going to give you their 20,000, but they're actually going to make over $1.2 million on you. And if you ever go into big cities, ever wonder why banks are really big buildings in there? Miami, Tampa, drive around, you'll see it. Even in Naples, got big banks down there. It's because they're investing your money at the high rate of return, but they're going to give you that 2%. So when I made the deal with you guys, hey, I'll give you a laptop. Here you go. Come throw me your money because I'm a nice, cool bank, and I'm going to give you that 6%. I'm actually still going to make a lot more money on that, even though it sounds like you get it instead of seems like you get it good. And we just call that legalized theft because it's not right that the banks can give you that when really they're making that, right? So with that being said, we're going to show the rule of 72 of an impact of a 5% loss. So we know that money always compounds out. So if it compounds out in a perfect world, it would kind of look just like this. So in this example, we're going to do 72 divided by 7.2%. to make it an easy 10 years. So everyone just gets that math. So he takes 72 divided by whatever interest rate. And this we're going to do 7.2 just to show 10 years to make it nice and easy. So in a perfect world, your money's just going to double on top of itself. So if you were to double out, the double rate is going to be 10 years. So you have $1,000. When you get all the way down to year number 10, it's going to equal $2,000. And that's what we showed on the last slide, was that every, however many years it was, every 36 years, every 12 years, every 9 years, it's going to constantly keep building up. So what happens, though, if you had, say, a 5% loss? What will it do to the compound effect of money? How is it going to affect it? So in this, we're going to have a 5% loss in year number 2. So we're going to take the same $1,000, and we're going to have a 5% loss in year number 2. Now, compound interest of money also works with compound interest of negative, right? So let's see how it really plays out. So in year 1, we have the same thing. And then year number 2, we're going to have, boom, 5% loss on your 1,072, which ends up equaling 1,018. Okay, so not so bad. You didn't lose that much money. But how does it play out in the long run? Again, compounding money, compounding out. Let's see how it works. So year 3, that's what we got, 4, 5, 6, 7, 8, all the way down to year number 10, which equals 1,776. So if anybody's really sharp at math, you can really pick up on, even though there's only a 1 year loss of 5%, the reality is actually 11.4. Because that 5% loss is actually compounding out over the next 8 years to actually being 11.4% loss in your return. And for that, we can just show it on year 20 on each side. It's going to be the same 11.4% loss with that one-time loss. So you see it down at the bottom, and we got the grumpy cat of finance because he's upset. He was grumpy because he doesn't want to lose his 5%, which actually is 11.4. So we're going to go into an example of a real-life retirement plan. Now, does anybody in here have a 401k, kind of IRA, any kind of qualified plan, anything like that? We have a couple guys in here that have that. So basically what we're going to do is that we're going to show the Rule 72 and how it kind of compounds out and what the effects are of those losses and other different things that are included with it. So for this example, we're going to just have, here are the facts. We have a guy who's 35, and he's going to invest money for 30 years. So from 35 to 65, he's going to take $500 per month, and he's going to throw it at a 10% rate of return per year. So if anybody wants to take a wild guess at it, what do you think you might have at the end of 30 years? What the total might be? Mike, you want to go for it? Take a shot? Yeah, so we're just going to play it out. So what is it going to be? It's going to be almost 1.8 million. It's 1,788,761. So he's 35, investing $500 per month for 30 years at 10% rate of return. This is what he's got. He's got the pretty blue number. So what we're not talking about, though, is what's happening in majority of 401ks, IRAs, any kind of qualified plans, is reality. And what is reality? Well, let's deal with it. Reality is what we see every day. So what is reality of that blue number? What is that pretty blue number that we get to see? What has to happen to it in order for us to touch it? So Andrew, do you know who are you in partnership with first and foremost? With your, what do you have, 401k?
I have an IRA.
IRA? So who are you in partner with?
Partner? Like who do I use as like a brokerage house?
No, that's who manages it. I'm just saying who are you in partnership with. When you go to withdraw that money, who gets the first cut?
That's Roth, so I pay taxes now.
Right. So okay, so that's a little bit different. But the reason why I ask that is the majority of people that have any kind of 401k or IRA, it's tax deferred. Meaning when they go to access that money, majority of taxes get taken out when they go to access that money. So if you were to retire, you have to touch money. But there's other things that are included with that. So market loss. Let's say that in this example we have market loss of 2 years. Now, I'm going to pull out this little book here. So we have 2 years of market loss. In the last example, we had 1 year at 5%. In this, we're going to have 2 years, one at 5%, one at 10%. And what we're going to do here is just like this is a little book. It actually shows the rate of return from 2000 to 2012. The actual rates of return to S&P 500, which is the top 500 companies in the nation. It's a good barometer to use. But we're going to show here in 2000. Mike, if you could read that out, what was the first year that we had there? So the first year in 2000, we had negative 10.14. In 2001, negative 13.04, right? 2002, we had negative 23. And then for the next couple of years, we shoot up. So 2003, we went up 26%. 2004, we went up almost 9%. 2005, up 3. 2006, up 13%, 2007, 3.53, and then in 2008, what was that one? So negative 38.49 in 2008. So boom, almost 40% of people's retirement plans were gone in a second. So money's in there, so it's a boom, it's gone. And then we had a couple decent years that kind of jumped up. So in this example, though, we just showed in the last 12 years, we had 5 years that were either losing double-digit negatives or 0%. There's a 0% in there, too. So let's say in the next 30 years, we only have 2 losing years, just because we want to be ultra-conservative. So then we agree that we were pretty conservative. In the next 30 years, we're going to show 2 bad years, and we just showed 5 in the last 12. But we're going to do 2 bad years, and we're going to do 1 at 5%, 1 at 10%. So we're going to see that. And then what else we got to deal with? Well, we got fees and commissions. In this example, we're going to show a 1.5% fee. The average is 3 to 5% in most qualified plans, 401ks, IRAs. And this we're going to show a 1.5% fee because, again, we want to be ultra-conservative by it. And then finally, again, tax loss, 25%, stiffen on the Roth IRA, I get that. But tax loss, majority of the time when you go to touch your money, you have to pay taxes on it, right? So we always say who you're partnership with, and we say Uncle Sam because when you go to access that money, who gets it first? You get taxes taken out, and then you get the leftover. So like I'm saying, we had almost $1.8 million put into a 401k, IRA, one of those types of plans, and we're going to deal with the reality of 2 years of bad market loss, fees and commissions of 1.5, and a tax of 25%, which most would probably fall in that tax bracket. Well, what is that really going to do to the bottom line? So after the 2 years of market loss and fees, what is the remaining balance? And if you want to guess, jump it in your head, it's $588,634, which means that you gave and paid others $1.2 million of your retirement plan actually went to paying other people. And for that, we're not happy with. And we like to show, well, if there's a different option, if you didn't have to pay that $1.2 million, dude, if you didn't have to give away $1.2 million of your money, would you do it? What would you want to know about? Right? I mean, how much would $1.2 million change your retirement from $588,000? Don't get me wrong, $588,000 is still a good chunk of change. But if you had your almost 1.8 over here, as opposed to $588,000, it's a no-brainer, right? So we're going to kind of talk about different strategies of things that we can kind of use to maybe help this. So there's a head coach for Alabama. He was a good, I don't know if anybody likes college football in here, but I'm a big college football guy. So the head coach of Alabama, a guy named Bear Bryant, he has a saying. He was always saying that offense sells tickets and defense actually wins national championships. And I agree with that. We had a couple rugby players in here we played with, and so everyone wants to see the good pass, a good run, good catch. Big plays, right? Sell the tickets, get people packed the stadium. But what really wins that national championship? And that's a strong defense. You want to make sure you got goal line defense there, stopping the guys from scoring. Because if you can score more points than the other team, you win the game. So we kind of applied that to this here. And so we're going to do a defensive strategy. I'm just going to write it down on the board here. So we have a defensive strategy. So what are the biggest things that we want to defend against? Well, the very first thing that's up top there, we want to defend against market loss. We don't want to have big market loss. So in this, we showed 2 bad years, but in the book, in the last actual rate of return, there's 5 bad years, all being double digits. So we want to have a good defensive strategy against market loss. We'll just do market loss. And then the second thing, exactly up on the board. So if we're going to have big defense, we don't want to have to be paying high fees and commissions, because fees and commissions will then, they're scoring points on us, they're going to eat away. We want to have goal line defense against fees and commissions. We want them to be low. So number 2, defensive strategy, we want low fees and commissions. And number 3, again on the board, good defense, you need to protect against tax loss, taxation. So we're going to write number 3, big defense against tax. We write tax loss. So we got our defense set. We need to have a good offense. We want to go score those big points. We want to go make the big plays, sell the big tickets. And number 1, we're going to go, if you're going to put your money somewhere, we want it to grow, right? We want it to grow to get that almost 1.8 million. So number 1 is going to be growth. There's your big catch. Number 2, if you want it to grow, what's the point of having it grow if you're not going to be able to draw income, right? So number 2 is going to be income. We want to be able to access that. So number 2 is going to be income. Number 3, again, if you're growing it and you're going to have income, you want it to be safe. You don't want to have that money losing again. So that kind of applies to our market loss. So we want safety to be number 3. And number 4 of our offensive strategy, you want it to be safe, you want it to grow, you want to be able to grow income, you want to have liquidity. You want to be able to have access to your money. Andrew, if you go touch your Roth IRA, what do you have to do to it?
Depends on the growth, got to pay taxes. Right now.
And for your 59.5, you have to pay penalties as well.
Right.
Usually about 10% penalty, and that's most qualified plans anyway. So you want to be able to have liquidity. It's your money, it's growing. You want to be able to access it without having the penalties to it. And then finally, number 5, again, it's going to be tax loss. We want taxation. We want it to be in our favor. And by tax loss, I'm going to put in little parentheses, tax-free, and we're going to talk a little bit more about that in a little bit. And here's our offensive, defensive strategies for what we use. And if we were to apply it to this, would we really have $1.2 million paid to other people? Well, if we didn't have market loss, if we didn't have the high fees and commissions, if we didn't have the high taxation, I can guarantee you that net investment return would be a lot higher than what it is. And that's what we like to show. And for that, I'm going to show a little quick video. It's a Yahoo video. It kind of talks about what's going on right now in America. It's pretty cool. We just like to show it. And then we'll go ahead and just play it here. So, pretty cool little video.
When I was younger, I never thought about retirement. Never entered my mind. Even to this very day, I'm still shocked that I'm in the position that I'm in.
I really never had any savings, and I was contributing to the 401k at my job. And when I got fired, I had to take some of that money just to live.
I seriously began saving when I was in my 60s. I'm sorry I didn't start a lot earlier. Nothing ever works out the way you plan it.
When I got into my early 50s, all of a sudden, I started realizing I'm never going to be able to retire. And I want to retire because, first of all, as I said, I did not have a career. I had a job.
People that I know, my friends, they're in their 70s already and they're still working.
I can't save for retirement right now with what I'm earning.
Over the last 10 years, I've had to really reinvent myself. So I applied for a university in the city. I was accepted, and now I'm living off of student loans. I'm probably going to be in debt for close to $200,000. And I honestly don't think I'll ever be able to repay that.
I have quite a few friends the same age as me that are trying to either reinvent themselves, trying to find a job. It's very hard over 50 to find a full-time job, and they're all struggling. We joke around that we may all live communal to make ends meet when we get older, because it's tough.
I sold some furniture. I had a friend pay me to paint their apartment. You know, I'm just doing whatever I can do.
All right. So it's a pretty cool little video, pretty striking numbers.
So
there.
many of the adults that are our age, they don't realize that there are better ways.
Yeah. And to go and continue talking about where do we go to apply these offense defense strategies, I'm going to go and invite Ryan Young on up to continue today. So thanks.
All right, I'm Ryan Young. Can everybody take a deep breath for me real quick? I need one myself, is what I'm saying. All right, thanks. That was good. That was for me. Thank you. So that was a lot, right?
Yeah.
You just got hit in the head with like 5 different snowballs, and you don't know what to do. You don't even know where they're coming from. You got Rule 72. How does money double? That's the most basic rule of how money works, and I bet a lot of us haven't even heard that. Am I right? Have you heard that before? Marsh, have you heard that?
Yeah.
By the way, that's Marsh Reed back there. His middle name is Reed. I'm a biologist, so we get along very well. Just saying. So, Rule 72. The finance guys don't even know this. You know, most basic rule of how money works. They skip right over it in the books. I have plenty of friends who have their MBAs who I talk to them about the Rule 72, and they're like, "What is that? Like, what? You know, there's more complicated stuff, and I know everything." Really, they don't, because if you don't know how money doubles, how are you going to apply that to yourself or to anybody that you're working with in the future? Anyway, that was pretty important, don't you think? Now that you know it, what we're going to do is we're going to try to apply it or work to learn how to do that. So then we go into the impact of a loss, and that, you know, that's pretty intense in itself. Snowball number 2, right? Hit you in the head. This is a lot of information, so we don't expect you to hold it all in one shot, but just put it in perspective and summarize what we just went over. 5% loss in 1 year actually equals 11.4. You remember we talked about in this book right here? Did we talk about this book right here? 4 out of the 12 years in this book were double-digit negative numbers. That means the market lost, what was it, 10%, 13%, 23%, 38%, and then 0, which is also a loss. Those numbers aren't real. If you think 5% actually equals 11.5, what do you think 38% actually equals?
Over 100.
Oh, yeah, when you come with something, you know, it's significant. You Rule 72 that, and you get something completely ridiculous. So you can see right in front of your face that our situation right now today is a little worse than what we're showing up here on the board. And we all got to pay attention to that. So that's what we're showing here. Then we go into a real life retirement plan. We're worried about these things right here. We're trying to defend against what we're showing. We're showing that we got market loss 2 years at 5 and 10% out of 30. Can anybody agree that that's pretty ridiculous? When we showed in the last 12 that 5 out of 12 were all losses, 4 of which were double digit. 2 out of 30 is completely ridiculous. We're being pretty conservative, right? Are we?
Yeah.
Okay. So commissions and fees, 1.5%. That's what we're running this at. The average commissions and fees on a qualified plan are 3 to 5% every single year. And that's not me saying that. That's been studied. And we have some videos and news articles done. An investigative report by 60 Minutes broke down all these qualified plans and showed that there's 12 to 17 different fees in every qualified account. Minimum of 12, max of 17, which equals about 3 to 5%. So 1.5%, we're being pretty conservative again, am I right?
Yeah.
Okay. Tax loss, 25%. We're going to talk about that a little more later, and it's going to blow you away a little bit. But 25% of your money, pretty average, still on the low side for when you have your money at its largest point and you're drawing a lot of it out. We're running an average tax right there. So really, this number, 588,000, it's going to be pretty much way less than that. Can you agree?
Yeah.
Being how conservative we're being. So 1.2 million to other people, that's not as big as it's going to be. And if you want to give all that money away, please come give it to me instead, because I would love it. And I'm going to do the right things with it, which we're going to show you how to do too, so don't worry. So what are we even talking about here? We're talking about applying strategies. We're talking about defending against the 3 things we just talked about. But then we don't want to sacrifice any of this offense, right? You got to score touchdowns and win games. So we need that growth in order for us to be able to have enough money to retire. And just so you guys know, we got a pretty young crowd in here. The number that they put out recently for our generation to be able to retire comfortably and the same standard of living that we're doing right now is $7 million. Does anybody think they're going to have $7 million in the next 30 years? I mean, I know I'm gonna, but it's kind of far out number. $7 million? I'm thinking to myself, how am I going to go get that? That's crazy. Well, we got to make our money grow, for one. So how do we maintain that growth and then be able to provide ourselves an income off of it? So with that, we want safety. So we talked about market risk, right? So we're talking about market risk. This red line, by the way, which I'll come back to in a sec, that's the market. Up, down, up, down. 5% loss equals 11.4%. We don't want to deal with that because we need our money to grow and we need that income. And Warren Buffett, by the way, he's one of the wealthiest guys in the world if you don't know who he is. His first rule of money is don't lose any money. And his second rule is see rule number 1. And I'll listen to him any day because he's one of the wealthiest guys there is. And he's absolutely right. You do not want to lose money ever if you don't have to lose money. Why? Actually, Marsh and I and Garrett were at the casino the other day, and I walked into the casino with negative $100. I knew it, and I felt bad about it immediately. I still do.
Still had a good time.
Yeah, I had a good time. It cost me $100. So I wasn't going in there planning to be safe at all. I was planning to waste money, which, you know, is not something that I like to do, and I'm not going to make a habit of it because that's just foolish. So we want that safety. Do not lose money, especially your nest egg. We're relying on this for our future. You do not want to lose any of that. Liquidity. We want to be able to access and get our money whenever we want it or need it, right? Qualified plans. Who has qualified plans in here? Nobody has qualified plans? You have an IRA, right? You said?
Mine's wrong.
Okay, but still, you can't touch that money until you're 59 and a half. If you do, you got to pay 10% penalty and taxes on all the gains, which kind of sucks, I think. So, to me, I want my money whenever I want it, whenever I need it. Say I want to go buy a house. I want to take the money that I put away for myself to go put a down payment on a house. I have a friend of mine who just did that, but he took from his qualified plan. He owes $7,500 worth of taxes at the end of the year because he took from his qualified plan. And he's at rugby practice, just whining, walking around, kicking rocks. He's like, I'm going to pay $7,500. It's going to be terrible. And I'm like, you should have listened to me, pal. I told you this time and time again, and he wouldn't listen. So he gets to deal with the consequences. Liquidity. We want our money when we need it. We never know what life's going to throw at us, and it's our money anyway, right? Yep. I want to do with my money what I want. Tax loss. We want tax efficiency is what we want. I'm going to erase this loss. Sorry, Gary. We want tax efficiency in our plan because when you save your whole life and it grows to the biggest it's going to be, then you got to pay somebody else before you pay yourself and your family. I'm not okay with that. Now, Roth IRA, great. You still got to pay taxes on the gains, though. Every bit of it. If you didn't have to pay taxes on the gains, would you want to know how to do that? Sure. Okay, good. Because we're talking about tax-free here. Completely tax-free. What's better, tax-free or tax-deferred? Bobby, tell me.
Tax-free.
Tax-free, you got it.
I win.
Tax-free is the way to be. So, where do we go to be able to do this? And if you go see a finance guy, a broker, anything, and he can't provide you a plan that gives you all 5 of these and helps you defend against all 3 of these, you turn around and run because he's not doing the right things for you. Not at all. Because it's possible. The problem is they just don't know how that's possible. A lot of guys have been in the business for a long time. Technology changes just like anything else. I bought a cell phone. There was a new one of the same model that was better 2 weeks later. Same type of thing happened in the finance world. So here we are. We're looking at this red line here. 95, 99% of people have their money in this red line. This is the S&P 500. Has anybody ever heard of the S&P 500? Okay, all right, it's mostly everybody. It's the leading index that tells us how the economy is doing. It's a barometer for how the economy is doing. And the Dow Jones, if you heard of the Dow Jones, that was the one that we used to use primarily. But that is just 30 different companies in 6 different industries. So it's kind of a smaller picture, and they're trying to paint a picture of the entire country. It's a little less efficient than the S&P 500 because what that is the top 500 companies in the country that hold over 80% of the income goes through these companies in the country. So pretty significant. And if they go down, we're all going down. So you can believe that the economy is based on what the S&P 500 is doing, or at least the market as a whole, because most of the money is there anyway. So most people's retirement accounts are right there in the S&P 500. This red line is that. Now, thank you, Ashley, for coming, because I pick on Ashley every single week, and she comes back again and again. We talk about how the red line is kind of like a woman's mood. Does anybody agree? Does anybody have a girlfriend in here? A wife? Something? Even you, Marsh?
Yeah.
Okay, all right. So you can agree then that sometimes she's really happy with you, right? You make her a card, maybe you do some arts and crafts.
Not Saturday night.
Not Saturday. So then Saturday night comes and what happens? Boom, she hates your guts. She doesn't even want you to come home. You're on the couch. But then you get up and you make breakfast, right? You make breakfast, try to make up for what you just did. Too bad you burnt the eggs, and they're terrible. So she's angry again. Then you make the bed, try to make up for it once more, but you forgot the sheets. So up and down, you really never know what's going to happen. That's what we say about the market. It's kind of like a woman's mood. Get it?
Yeah.
Okay. Up, down. This is what's going on in everybody's retirement accounts. So you can see that we're clearly not defending against market loss because there it is right there. Fees and commissions. Well, let's look at this for 1 second. All right, 1997. This is a real example. If you started with $100,000 in 1997 and you had your money in the S&P 500 or in a retirement plan where some of your money was there, this is exactly what it would have done. So you start at 100,000, you're going up, boom, down. 2001, the dot-com crash they called it, or bubble. Then you go up, climb it again, then you get the real estate crash. There it is. Then you go up. Can everybody guess what happens next? Just take a guess.
I think it's going to crash.
Wait, maybe? You think so? Okay, all right. I think a third grader could figure that out. It's a pattern, circle, square, circle, square. That's what I say every time because anybody can see what's about to happen. It just doesn't make sense. It just makes sense, actually. Okay. Anyway, you start with 100,000 here. We're ending with 165. Now you'd like to have 165, right? 165,000 in your bank. Start with 100, you end with 165. Not bad, right? You're pretty good. Yes?
Yeah.
Okay, there we go. I was looking for that. All right. So, but when you get here, remember who are you in partnership with? Uncle Sam, yeah. So you just put your money in, tax deferred, great, right? Okay, you get to 165, and then before you get to use or take any of that money, you got to pay your uncle. So let's say it's 25%. 25% of 165 is what, Trey?
A lot. More like 35, 40,000?
It's about 40,000. So let's knock 40 grand right off of that. Okay. But when there's one more thing we're not accounting for here. We're not accounting for over these years, you're paying somebody to go play with your money. So when you slide your money across the table to Broker Joe, who carries all the risk?
You.
I do. We do, right? So let me get this straight real quick. You're sliding all your life savings across the table to some guy that you don't even know who doesn't have any risk, and you're going to pay him 3 to 5% per year whether he wins or loses. Is that right? Is that what you're doing right now?
Not me.
Not you. All right. That's just some of us in here that are doing it. I have some money in those places locked up. I can't do anything about it, but I'm trying to get it out, believe me. Because that just doesn't sound like a very smart plan, does it? No. Not only that, but you're also in partnership with somebody else this whole time. Slide your money across the table to Broker Joe. He has no risk. You're paying him whether he wins or loses, and you're giving a big chunk of money to your Uncle Sam before you can even get it. Kind of crazy to me. So what we're going to think about now is, okay, you have 100,000, you get to 165. That whole time you're paying this guy 3 to 5%. Let's say it's 3%. 3% over 10 years is what?
30,000.
About 30,000, right? 3% per year over 10 years would be about 30,000. So let me get this straight. 165, we said that's pretty good, right? You'd want 165 if you started at 100. But then you got to pay your uncle. Here you are. Then what this doesn't tell you is over these years you had to pay fees and commissions on all that money. So minus 40 for taxes, minus 30 for fees and commissions. Where are you at? You're less than where you started. That's 12 years of trying to save for your retirement, your life savings here, thinking you're doing so good, right? Then all of a sudden you're less than where you started? That just, to me, makes no sense. It makes me angry. I don't know if any of you guys get upset about that, but I get really upset about that. 12 years, that's a waste of time. What are you going to do when you hit retirement? You're going to be painting houses like that lady was. I don't want to be those people in that video. We're all going to be there if we don't do something about it. Am I right?
Yeah.
Okay. So we got to think about this kind of thing. So what we have is an alternative. Things change, like we said. Laws change. You know, technology changes. Same thing happens in the financial sector. So we have been doing some work with a new product that helps you get all of these things we're just talking about and avoid all the horrible things that are happening to you in Redline, and that's the blue line. What the blue line is called is an IUL. It stands for an Indexed Universal Life Contract. It's a retirement insurance contract. So I'll tell you a little bit about that. First of all, we can see what happens here. Comes up, your money's contractually guaranteed to never lose a dime ever. No loss. You're getting market rates of return without any of the risk. The fees that you pay to have this are half as much, plus you get a service along with that instead. And not only that, but that's completely tax-free. So I'll tell you a little bit of history first before I go into Blue Line and show you how that's even possible. So tax-free, have as many fees, market rates of return with no risk. Sounds too good to be true, doesn't it? It does, doesn't it? What's too good to be true is that most people don't even have a clue about this. I sat in this very room and took a course with a guy who's been in the industry for 35 years. 35 years. And as we're going through the book, we came up upon this. And I knew that I was studying that because I had learned about the product, and I was excited to be able to, you know, get into class and learn more about it from some guy who knows everything, right? Who's got all these plaques here. But we got to that section, and basically we just mentioned it and skipped right over it. That was it. And I raised my hand. I was like, can you tell me a little bit more about that? He's like, yeah, no, not important. On to the next one. People are in the industry for years, and they get used to the old school. You know, they don't know what's up with new technology, just like your parents probably can't operate a computer at all. I know my parents can't. That's my dad back there. That's him. I have to show him how to attach him to an email every single time. I'm okay with it. I'm charging him now, so $5 per attachment. Anyway, so what made this possible? Let's talk about the history so you understand what this means. In over 50 years ago, there's tax codes. So we use two of them. We use 101 and 7702. These are two of the tax codes we use to make this possible. To make the money grow and be able to take it tax-free. So that's what that law says. It says so long as you have your money linked to a life insurance policy at a certain ratio, you're allowed to grow and take your money tax-free. So rather than growing it in a Roth and having to pay the taxes on the gains that you're getting, here you're growing it and you don't pay taxes on any of those gains. You put it away, then it grows completely tax-free and you take it all tax-free. So the tax code, these are two of the laws. Now, who in here has read the tax code? Anyone? Crickets? I hear the crickets. Because nobody's read the tax code. I knew the answer to that question already. Go talk to an accountant. Ask them if they've read the tax code. They might say, yeah, I've read the tax code. How many pages? Ask them that. What's up, Paul?
My buddy's studying tax law. He's going to be a tax lawyer.
Yeah.
And he said, I was like, so have you read the tax code? Hell no. You don't even know how big that thing is. I go, you're right.
The tax code is 93,000 pages long. I think if you were to attempt to read that, it would take you 2 lifetimes. I'm pretty sure. Maybe get on that Mars flight or get on the flight to the next solar system. They just made some new space engine or something. Now you got plenty of time to read the tax code. So, nobody's ever going to read that. 93,000 pages long? I don't think so. So, you know, we talk to people who know specifics, and these two are the ones that we work with to allow this to be possible. There's several other ones that we work with too to do some other fancy things with financial planning, but these are the ones we're going to deal with today. So, like I said, put your money away, grow it, and take it tax-free. Pretty powerful, right? So, that is what allows this to be possible. Let me now talk about number 2. So, the strategy of an investment. How do you get great returns on your money? One of the best ways, a guy named John Bogle. This is part 2, all right? So this is number 1. This is what makes it tax-free right there. This is part 2 right here. John Bogle. In 1976. 1976? Yep. Yes. I kept switching the 7 and the 6. All right. John Bogle, 1976. If you know, is anybody familiar with the Vanguard funds? Okay, well, Vanguard funds, one of the most powerful mutual funds out there, right? That guy owns and runs the Vanguard funds. So what happened back in the day, 1976, before any of us were even a thought, John Bogle, he was investing in the market just like everybody else. And what do people do when they're brokers? They buy, they sell, they buy, they sell. They try to time the market so they can get the best returns for people, right? We all know that that is impossible. You never know what is going to happen in the world. There could be a tsunami tomorrow. There could be an earthquake here in Florida. Nobody would ever expect that. You know, crazy things happen, and you cannot predict what's going to happen with the market. There could be a big crash tomorrow. Just a few weeks ago, all the returns of 2014 were lost in a single day. In a single day. Did anybody see that coming? Not really. It was all hype because of some government regulation that was going on. So if you could lose all the gains that you made in the whole first quarter and a half of the year in a day over hype, you know that you cannot time the market. It's impossible. So John Bogle, 1976, said, I've had enough of that. I'm not trying to time the market. You guys are dumb. That's impossible. So he went to the S&P 500, and he invested an equal dollar amount in all 500 companies in the S&P 500, and he sat on it for an entire year. Didn't even touch it. So at the end of the year, what do you think happened?
He won.
Yeah, he won. He did win. He beat 9 out of 10 of all those guys trying to beat the market. Buying, selling. He beat 9 out of 10 of them. And what that's called, that was the birth of the indexing strategy. That's not a place to invest, that's a strategy of investment. So this is how indexing was born. Indexing. So, and some white papers came out recently, a few years ago, that I found. I'm a biologist, so I do science stuff all the time, and I like to do literature reviews. So when I started learning about this, of course, my number one goal was to rip it apart and find everything wrong with it, which I'm sure many of you will do too, and you should, because that's what I did. As a scientist, I said, let me figure this out. Let me break it down to its bare bones and see how and why and if that even works. So I looked up indexing and I said, okay, tell me about this. The white papers, they do studies. White papers are professional studies, usually done in specific industries, to test products and strategies and other things. So they took indexing and compared it with every other type of investment strategy you could possibly do. They put it next to it, and they said within the first 5 years of implementing an indexing strategy, you win 85% of the time, and after 5 years, you're winning 92% of the time. Does anybody like those odds? I mean, I'll take 92% of the time winning. Why would you do anything else? It just wouldn't make any sense, right? It's statistics. That's what I do for a living, statistics. And it says, do indexing. When you're a scientist, you look at the stats, it says one thing, that's what you go with. Otherwise, you're kind of just stupid. Sorry if I offend anyone. And if I did, I meant it. So, sorry. But, so we got indexing here. That's number 2. So, number three. Let's see here, there's a number 3. So, we have tax-free growth. We got an indexing strategy, and let's go to blue line here real quick. You see what's happening here? See the red line going up real steep, right? Mm-hmm. Blue line, not as steep. So what this is, oh, I got it, number 3, sorry. Let's go back to number 3. I'm explaining what I was just talking about. So number 3 is, in 1999, there was a law change that changed everything. The reason why we're in this room right now. So prior to that, there was
Glass-Steagall.
Glass-Steagall Act. Glass-Steagall Act. It said banks can only do banking, stockbrokers can only do stocks, bonds, mutual funds, insurance companies can only do insurance. In 1999, they dissolved that law. This is Glass-Steagall. Just put ST. They dissolved that law, and Glass and Steagall are two guys, they're the ones who put it into effect originally. Dissolved it with the Financial Modernization Act. And what that said is that banks, banks, brokers, and insurance companies now could compete with each other. Before you couldn't cross the streams, like Ghostbusters, right? Don't cross the streams. Don't ever cross the streams. Now you could do that. So they could all compete. We're talking about consumer advocacy, right? Competition is always good for the consumer. So in that competition, who do you think won? I don't know. Take a guess. Banks. What?
Insurance.
It's insurance companies. Why is that? Can you tell me why that is?
They have the most money in the world.
They have the most money in the world, more than anyone else, which allows them to be able to guarantee your money, number one. And number two, allows them to do a whole heck of a lot more because they have the power. Think about it. 85% of the global wealth is tied up in insurance companies. Why? You guys all drive, right? Is everybody driving here? Yep. How many years have you been driving? Byron, how many years have you been driving?
8.
8 years? So how many times have you gotten in a car wreck?
I have never ever used the car.
So you're telling me you pay insurance every single month for 8 years and never once have you used a claim on your car insurance? Okay. So there's a prime example. That's 100% profit, ladies and gentlemen. 100% profit on one person for 8 months. He's got to do that for his whole entire life. Then you got homeowners insurance. Then you got health insurance, which is now required for everyone. Then you got life insurance. You got every kind of insurance you can possibly think of. Mortgage insurance. You got all kinds of crazy stuff. So there's a reason why they have more money than everyone. And that's what gives them the power to be able to do whatever the heck they want. And they're able to guarantee you your money. And a lot of insurance companies, especially the ones we work with, they're called legal reserve companies, which means every dollar of liability that they have, so every dollar that you have put away or every dollar that they owe someone, they have to have at least 103% of that money sitting there ready to go whenever it's necessary. So back to blue line now. What does this mean here? Okay, blue line's going up, not as quick as the red line. So what an IUL says is that you're capped at 14%. So 14%, that means, Marsh, if the market did 20%, what are you going to get? 14%. If it did 13%, what are you going to get? 13%. You're right. Actually, absolutely right. If it did negative 10%, what are you going to get? 0. Contractually guaranteed never to lose a dime of your principal or your interest gains, ever. Now you're capped at 14%, and you might be like, oh, but I'm capped, right? Well, that stinks. Tell me how many times the market went over 14% in 12 years. Right answer, it's 2 times. In 12 years, it only hit over 14% twice. And one of them was, I think, 15%. Was it? There was one year that was 26, and one year that was 23. All the rest were either double-digit negatives, 0, or under 14%. If I can get 14%, I'm going to take it, especially if I can guarantee that I never lose a dime and I'm growing my money tax-free. Yes, Byron?
On top of that, if you have a retirement account, most of them are diversified, so if you go up, if the market goes up 25%, more times than not, you're not even getting 15% of that.
Exactly. You think if the market does that much, you think you're going to get that much? No, no, no. When you have a retirement plan, say with your work, this happened to me. So I know personally. Last year the market did 30%. What did I get? Probably 12. Why? Because they tell me to diversify my portfolio so I could, cushion the losses and, still get gains. But what does that do? It diminishes my gains when the gains are available. Way less than what they actually are. I actually got 3% when the market was doing about 25, and I was very upset. Yes. When you have your money contractually guaranteed, what we do you get 14%. If the market does 14%, you get 14%. So that's another thing. So blue line, we're going up. Market's going up real steep, right? You're getting what here? What are you getting? Maximum. You're getting 14%, 14%, 14%. What happens in 2001? Boom. What happens in the IOL? 0, right? So here we go. We're gaining with the market again, gaining with the market again. Then what happens? Huge loss, 0. You maintain all your gains and all your principal. Then you get up here, and what we're not seeing here a lot of times is this number here, this red number, that's a gross number. Remember we talked about it? It's disgusting actually, but it's gross. What I mean by that is it's before you account for taxes and fees, taxes, commissions, and fees. So remember, we ended less than what we started at, right? Okay. Up here, this is a net number. Because it's tax-free, and because the fees are already built into it through this whole thing. So the question is, would you rather $95,000 or $211,000?
Ding, 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 ding.
Yeah, it's a pretty simple question to answer. So that's just so you can understand the mechanics. Now, why is it so important to get this money tax-free? We're talking about tax-free, tax-free, tax-free. Why? We got to understand what's happening in the world. Does anybody pay attention to current events at all? Anyone? I read the news every morning. I try to pay attention to what's going on and, be astute so I can make adjustments based on what's happening in the world around me, right? So, a little history, not history, that's happening right now. So, there's a guy named David Walker, and he used to be the head comptroller for the United States, which is the head accountant. He didn't read the 93,000 pages either, don't worry. But he was the head accountant for the United States of America. And he helped to oversee what's called the CBO. Anybody ever heard of the CBO before? Okay, got some CBO knowers in here. That's the Congressional Budget Office. If you're watching the Finance Channel or anything like that, you'll hear a lot about them because what their job is to look at the decisions that the government's making every day and tell you what the impact will be on taxpayers. So what is gonna happen in the budget financially based on the decisions the government's making, right? Okay. So CBO, David Walker said, do a study for me, CBO. Tell me this. Tell me out of these 4 departments of government, how much of every single dollar of taxes is going to just those 4? Follow? Okay. So those 4 departments are Social and Security. You get what I did there? Oh, yeah, right. Why is it Social and Security? Because we're not getting it. None of us. I just read last week that Social Security in 2016, which is just over a year from now, is going to be underfunded by $30 billion a year, and they still don't know where the money's coming from to make up for that. I mean, I can tell you right where it's coming from. They just didn't want to say it. It's coming from all of us. And where it's probably coming from is our qualified accountants right now, because we're in partnership with our uncle already, right? And you already heard Obama say once, talking about MyRAs. MyRAs is this. And personally, I don't want a country that's $17.5 trillion in debt managing my nest egg. That just doesn't make sense either. No way. So, Social and Security, go over that. Then we got Medicare. I have terrible handwriting, so forgive me. Medicaid. And the interest on the national debt. That's the 4th one. Biggest national debt of all time right now. So, he said, what's going to happen? How much of every dollar of tax money goes to just those 4 departments alone? So, what do you think? Anybody have a guess? You got a guess? No guess? Out of $1, how much?
60 cents.
60 cents? Anybody else? What do you think? 50 cents? Okay. It is 76 cents of every dollar. So let me ask you this. Do you think that the government can run on 24 cents of every dollar? I'm talking about the Army, the Navy, the Air Force, National Defense, National Parks, EPA, roads, highways, railways, anything you can think of that's managed and controlled by the government. The whole entire Washington, D.C. running on 24 cents out of every dollar of tax money? It's kind of a stretch, don't you think? Yeah. That's a deficit, which is what we're in. So he said, tell me by, okay, this is right now. He said by 2020, what's that number going to go to? If nothing changes today, what is that number going to go to? 76 cents. Based on what's happening with the debt and everything. Anyone?
90.
90? You're close. 92 cents. Does anybody think we can run the government on 8 cents? I sure don't think so. That's even a bigger stretch. We're going to be
stretching.
Yeah. Well, the money's got to come from somewhere, right? If we're going to sustain and maintain it, not completely collapse and go nuts, we need to get that money from somewhere. So where's it coming from? It's coming from all of us, all of you guys. Congrats, you're funding the government. All right. So what's going to happen to the taxpayers? So David Walker said, go tell me what the impact on the taxpayer is going to be if and when that happens. Nothing's changing, I can tell you that. Not right now, anyway. So we got how many tax brackets in the country?
6.
6. Okay, 6 tax brackets. Byron already knew that.
Yeah, I'm going to go with 6.
6 tax brackets in the country. Yeah. So I'm going to use 3 of them. I'm going to use 10, which is the bottom tax bracket. I'm going to use 25, which is the median one, and then I'm going to use 39.6, which is the highest tax bracket currently. And it's already gone up twice in the past 2 years. So what's going to happen to the tax rates when this happens? And I'll just tell you right now. 10% is going to 25. 25% is going to 66. 39.6 is going to 88%. 88%. So if you saved $1 million for your retirement and you have a qualified plan, you feel real good about it. You're like, I am all set for my future. Guess what? Before you get one dime of it, you got to pay your uncle, who you're in partnership with, $880,000. If you saved $1 million, do you think you're okay with surviving on $120,000 for the next 30 years? Yeah, right? I'll fight you for it, exactly. 88%, I don't think so. That's not happening. No way. I saved my whole life. I'm not giving you 88%. So this is data. This is what's happening right now. This is a study, a mathematical study done by the CBO that they came out and said this is what's going to happen by 2020 if nothing changes. And even if something did change, I don't see it being far from this. Now, you might think that 88%, 66%, you're saying that's crazy, right? I mean, 39.6, who thinks that's very high right now?
Sure.
You think that's pretty high, right? You don't want to pay that much money. That's a lot of money. It's almost 40% of every dollar you get. So, in real life, the average tax rate in all time is 62.1%. Right? That's crazy, right? We're young. We don't realize that. It's called shifting baselines. We talk about it in science all the time, actually. Shifting baselines is, one generation thinks it's this way. The next one comes, it's a little different. The next one comes, they don't even remember what it was like 2 generations ago. So, look at this. Right now, we're at 39.6, right? There's only been 2 times in all of history lower than this one of the United States. 35, then we're at 39.6 now. It's higher than this, but only 2 times. So look at this. At one point, it was 94%. It was 91% at one point. For years. For years. That was normal to these people. Now, we're all saying 39.6 is high. No, it ain't. It's not high at all. So if we're not preparing for that tax that's going to hit us, we're going to get hit by it. It's going to hurt real bad, too, I can tell you that. So we're showing people how to take their money and grow it and take it tax-free to avoid exactly this. Remember, we're avoiding tax loss. We're avoiding high fees and commissions for a guy that carries no risk that you don't even know, that you pay him whether he does good or not. And we're trying to get tax efficiency and tax freedom. So one more thing real quick before I turn it over to Trey here. This is the history right here. We got the percent of debt to GDP and then the tax rate. So this is debt right here. It goes real high. What happens to the tax rate? Whoop, it goes way up. So they're correlated, right? Where are we now? This is the debt. This is the tax rate. What do you think's got to happen? There has to be balance, right? It's got to balance out. It's happening right now. So this is how we plan for those things, and there's some other parts to this that make it even better. The fees that you're paying within this, which is half as much as you pay in a qualified account, actually provide you with a service that is really going to benefit your life and also your legacy. So for that, I'll talk about Trey, who talks about it better than anybody else.
All right, good evening, everybody.
Hey, Trey.
Good evening, Trey.
Hey, Trey.
All right, first thing I'm going to go ahead and do is, if you're new, Gene, we got a couple guys back there. Grab a piece of paper, write down 10 names that you know, care, and love about most in your life right now. Can you do that, Gene? Give me a piece of paper. Like I said, 10 names that you know, love, and care about most. All right, everybody. Be good. Just so you know, so you don't get confused, there's been a lot of information thrown at you tonight, but don't get confused because all this is simply life insurance. So you're going to acquire 3 things with an IUL, which is what the blue line was, an IUL, Index Universal Life Contract. First, obviously, it is life insurance, so you have the death benefit. You die, they pay. But we like to ask people is, you know, do you have the old kind and the new kind if you have life insurance? Because the old kind, you got to die to benefit from it. It sucks. You know. But just like technology and medicine advances, so do the laws and regulations of life insurance. So they have something called living benefits, which to me is a personal crusade in my life. And it's the reason I do this, to be honest. Because to get people tax-free income and establish something for the future is great. But to actually, you know, be there for people when they need us at the worst is why I do this. So what I'm going to have you do is go ahead and out of those 10 names you just wrote down, cross 7 of them off. Doesn't matter who, just cross 7 off. Now, the reason you're crossing 7 of those off is because it's a proven fact that 7 out of 10 people will have a heart attack, cancer, or stroke before they turn the age of 65. Now, by a show of hands, who in here knows somebody that's had a heart attack, cancer, or stroke and still survived? Everybody, except you two, the younger guys back there, everybody. Okay, so majority of people. And it sucks, because what happens is, you have health insurance. These people have health insurance, so you go to the doctors, you have a heart attack, you know, the doctors get paid, hospitals get paid, but you don't get paid. So how are you going to survive, Gene, if you have a heart attack in a couple of years? How are you going to pay the bills for a year when you can't work?
I mean, disability or?
It takes a couple years to get
yeah,
disability.
It takes a couple years, but if you have
retirements, you know, if you have qualified plans, you got to pay the 10% access fee, and then that's your nest egg. That's your future. You know, it sucks.
401k, because I'm using that example based on my dad. So,
yeah, and it sucks to have to do that, you know. And I you know, the reason I'm very passionate about what we do is because we can prevent that for people. Now, the Bernard brothers, they started open heart surgery in South Africa. You know, they're saving people. I'm gonna keep this short and simple, but they did serve this. A lady had lung cancer. They kept her alive. She was good. She had 2 children, came for a checkup, and she just looked horrible. And the doctor was like, you know, what's wrong with you? You can't be working. You can't. And she said, look, I have to. I have 2 kids. I got to put food on the table. I don't have a choice. Long story short, she ended up passing away. So the Bernard brothers, who have a big influence on the insurance companies over in the UK, went over there and said, hey, look, you know, you guys have the life insurance. You're going to pay these people when they die. You know, but why you wait until they die to give them money when they can benefit it when they're still alive? You know, you're going to pay them $100,000, $200,000, however much their death benefit is. Why not give it to them while they're still alive? Hence, that's where living benefits came from. You know, I've seen it happen in my own life. My mother passed away at the age of 44, had 2 strokes. My father's had one at 48. I have an uncle that's had one. My grandmother died of breast cancer. Everybody in this room said they know somebody that's had one. So if 7 out of 10 people are going to have one of those 3, what's going to make us any different? Right now, we're young. We're all in our 20s, except a couple of us. So we feel like Superman. We feel great. You know, but what's going to happen in 20 years? What's going to happen in 30 years? What are you doing to prevent yourself from that? Because I've seen it happen in my own family. I lost the house. You know, I got left with debt, and it sucks. If you can protect yourself, your family, your loved ones, would you want to?
Yeah, absolutely.
What, right? Do you think everybody on that list that you just wrote down, those names, should know about living benefits, should know about tax-free retirement? Do you think so, Gene? The guys back there? Would you agree? That's great. All right. So now, who in here likes money? We were talking about money earlier. Oh, everybody's hands went up there. All right. That's cool, because right there, you guys wrote down 10 names. That's already 10 people you got to go sit talk to. If you like money, you want to make money, that's already 10 people right there for you. And don't worry about learning everything, wanting to know everything, because whoever brought you here, we got coach. We got great guys that are going to guide you and help you along the way and train you properly. Now, you guys get the story. You get the tax-free income. You get it's just simply life insurance. It is a license, you know, a regulated industry, so you do have to get licensed, which isn't hard. We'll tell you how to do it. But you get the life insurance. You get the living benefits, which is my personal crusade why I do this. You get the tax-free income. Do you think it's hard to explain that to people? No. If you had someone to help you do this, you know, whoever brought you here to sit down and show this to somebody so that you learn the language, do you think you could do it? Yes. Do you guys think you could do this?
Pretty simple, right?
If you had someone to help you guide you along the way until you're good to go? All right. So now, let's say, Gene, you say you could do this, right?
I can do it.
All right. So if you go and you got 5 people, here's Gene, and we're going to give you 5 people just to introduce this. All right. So 5 people are like us, that like money, that want to make money. You know, tired of being tired of, you know, building somebody else's dream, that want to do something good for people. Because what we're doing for people, like personally, I don't know what else better you could do for somebody. I really don't. I really don't. And that's why I'm so passionate about what I do. So say you bring 5 people, Jane. Everybody in this room, you bring 5 people. Like, great, man, I love it. I want to do it. I see the opportunity. I have a dream. I'm on board. Cool. 2 of them are duds, though, immediately. Now, a VP contract, which isn't hard to get to, will show you how to get there. And the average customer is spending $300 because that's what they actually do. So you got a VP contract with our company, and the average customer spending $300. Gene, do you think you could show this to 2 people a month and show them how to get point A to point B, and just provide them with a choice and let them make the decision on their own? Yeah. Okay. Now, let's say you did 2 people a month. That just isn't hard at all, because I've done it in a week. I've done it in a day. And then you have 3 people that do the same thing. So this guy gets 2, he gets 2, he gets 2. Now, this is a business opportunity, so keep that in mind, because the first time I came, I seen this number right here, and that's why I'm in this business. Because if you can do that at a VP contract, you have an annual salary of $127,000. Now, we all said we like money, right? Does that look like good money?
Yep.
Mm-hmm.
If we could show you how to do that, would you want to do it?
Yep. Absolutely.
Right? I love Paul. On the way up here, Paul said this. He said, you know what? How many of you in here have dreamed of making $1 million? Raise your hand if you have. All right. Now, have you ever had an opportunity and actually wholeheartedly put forth the effort to actually pursue that ambition and say that you did the steps necessary every single day to do so? Who in here did that? Besides Coach? Nobody. Nobody, right? The opportunity's right in front of your face. It's right here. I can't think of any reason why you wouldn't want to do this. There's no gotchas. Like I said, a lot of information was thrown at you tonight. You know, so don't worry about trying to learn it all and learn everything. Come back, set the one-on-one with whoever brought you here. Fill out the CNA. We're going to be here. We're a team. Me, Paul, Ryan, Bobby, Byron, Cody, Garrett, Andrew. You've even came a couple times, man. It's nice to see you in here again. we're all a team, man. We talk every day. We motivate each other. We tell each other, experiences, things that we're going through. Been doing this for about 4 months now, and to be honest, it's changing my life. I am getting paid, and it's nice, and I get to help people, man. I get to prevent people from seeing that in their life. How are you going to feel when you provide somebody with an IUL that has living benefits, because there's only 18 out of 2,700 companies in the entire nation that offer living benefits right now? Yeah, better than selling wine. Whatever it is you do. I move furniture for a living. I wake up every morning at 6 in the morning. I hate it. I hate my life. I go there, I see my boss driving a Mercedes, but yet he can't afford to give me a Christmas bonus? Get out of here, bro. Get out of here. I'm serious, so it sucks. And all of us do it. We don't want to work for money. We want money to work for us. And that's what we're doing here. We're simply building a business. Who wants to own their own business? Who would like to change people's lives, man? I don't get it. I don't get it. People come here and see this, and they vanish. Like, how could you at least not want to retire? You just learned a lot tonight. You have a qualified plan, right? I mean, what you learned, they didn't teach you that. When you went and got your Roth, you got the Roth and you got a 401k or whatever. When you went and got it, did they sit down and explain this to you? Or they just put a piece of paper in front of your face and say sign? Every single person I talk to says the same exact thing. So don't feel bad. Like I said, a lot of information was thrown at you guys, and I appreciate all your time. What would you like best of all that you heard the speaker say tonight? That part. I like that, because that's what I said, not kidding. It's true, though. It's true. There's no reason. If there's other guys doing this across the nation right now, there's no reason we can't do it. If there's people out there making millions of dollars, why can't we? The opportunity's here, man. It's easy. Take the time to educate yourself, become licensed, plug in, learn the language, learn everything, and we're going to help you do it, and it'll happen.
Actually, I started working for another job right now, and when I was signing up, they looked at me and said, "We have this great retirement plan called a 401k that we have through our business," and slid the paper across me and said, "It's great." And I said, "What's great about it?" It's what you can save for retirement. I go, I was like, I'm okay. I already have a retirement plan because I'm financially independent. So I thought it was funny because they didn't tell me anything about it or anything. They just said it's great. They had no idea what they're offering.
Everybody I talk to,
it's great.
Has a 401k. It's the same thing. Same thing. It's a government qualified plan. So who do you think is going to benefit?
The government.
Yeah, and if average broker Joe over there isn't going to get to manage your money all these years, is he going to tell you to go put it in an IUL where he's not managing it and he's not making commission on it? Nope. What we're doing for people is there's nothing better. There's nothing. I've done my research. Paul's done it. Brian said he has. Coach is a very intelligent man. He wouldn't come out of retirement and start a company if it wasn't right for people, legally and morally right. And I wouldn't be on board if it wasn't. Because I have good morals. I was raised with respect, and I want to do something for people that's profound. When people ask me what I do, I said, go ahead, ask me what I do, Paul.
What do you do for a living?
I make a profound difference in people's lives. What do you do?
I make a profound difference.
I actually said that to somebody, and they just looked at me and like, wow, what do you do, man? It's crazy. Ron, what do you like best? Any additions, anything?
I liked my presentation the best. I thought it was great.
James, what do you like best about what you heard tonight? The money.
The money part.
The money, right? And you know what's great is you can do this part-time. You don't have to quit your job immediately. There's no, I don't know if anyone knows the verb stuff or the, oceans bills. There's no, hey, come invest $500, you can join the team. No, this is you. What you see is what you get. There's nothing. You're not investing anything but your time. If you want to be somebody, I'll help you be somebody. I'll make a commitment to you, but you got to be a man of your word. We have to have integrity and hold each other accountable. Otherwise, I'm not going to waste my time because I'm going to the top and I want to bring whoever wants to come with me. And if not, then I'll be waving at you. Any additions?
You can't go with, like Trey says, we can do this, why can't you do it? The resumes we have, you can't go anywhere else to make 6 figures. You just can't. Only 4% of the whole United States population makes over $100,000 a year. So this is very powerful.
You don't need it's very true.
And another thing, qualified plans. You guys got qualified plans? There's $17 trillion in the qualified plans in the United States. We also have $17.5 trillion in debt. Coincidence? What do you think they're trying to do?
Cody, any additions, deletions?
I just be more excited every time.
Yeah. And you learn more every time, right?
Every time.
It's great. Honestly, I'm not a smart dude, man. I cheated my way through high school, dropped out of college, But I took the time to go get licensed, and now I don't even turn on the TV, man. I read, I educate myself about what we're doing. You know, I take the time to while my buddies are going out to bars and stuff, I think about, you know, hey, my future, man, what am I going to do? I want to retire. I want to, you know, I don't want to be out, you know, we're bagging groceries 70 years old. That ain't for me, man. That ain't for me. You said you like the money. What about you, bud? I don't even know your name.
Kale.
Kale? Money?
Yeah.
Who doesn't like money? That's great. Hey, if you like the money and you're a man of your word, then you'll come back and we'll show you how to get that money. Because there's people doing it. I'm going to be doing it. I already am. Andrew?
I like it all.
I like it all. I like it all. What about you, man?
Affirmation. I already believe in yourself.
Right on. You've heard about NIUO before?
I sell insurance.
Okay. So you knew about NIUO? You already have a 214, 215? Who brought you here? All right on. And who brought him?
That's why I brought him.
My guy brought him.
Yeah, that just goes to show you, though, you know, everything we're here is completely, we're saying is completely verifiable. Go ahead, look it up. Do whatever you want to do because I've done it to myself. You know, and it's just human nature to be that way. What about you, guy about the insurance guy?
The investment.
The investment? I mean, it's good to know that you can put money somewhere and have it contractually guaranteed and never lose it, right? That's how I put it to people. If you could go to the casino, you go to the casino this weekend, right? You bet. Say you're betting this, you lose it, it's gone forever, right? What if you could bet this, you lose, you get it back? That would be a better form of betting, right? Then everybody would bet. Well, that's what we're doing.
It's there.
It's there, yeah, it's available. You know, I can't. Garrett?
I like the guy that didn't move something.
Yeah, he was great. He was great. Ashley?
Personally, I like the living benefits card best because if I would have known about this probably a month and a half ago, I would have helped my family because my dad has cancer now. So, I mean,
There you go.
if I would have known about this a little sooner,
That just gave me chills, man. That just gave me
it
chills.
would have been a little
How are you going to feel if you've seen this tonight, you didn't go talk to somebody and that happened? How are you going to feel?
Like there's something you could have done about it.
That, like, when you do, it's not what we do, it's why. And it's living benefits. You got to understand that.
Don't
There's
get me
nothing
wrong
better.
though, the money's great.
Oh, the money's great, you know. But the thing is, when you give back to people, success will follow. You know, we're not out here doing what's wrong for people. We're doing something that's great. And just for anybody that doesn't have time or thinks they don't have time, Paul sent me this. What is it, 168? 168 hours in a week. 40 for sleeping, 56, excuse me, for 8 hours of sleep every night.
Yeah, 40 for the full-time job.
40 for the full-time job, excuse me. You guys got that pretty handwriting, but you're left with 72 hours in a week. Who doesn't have time? Take 50 hours to go spend with your family, go to do whatever you want. You still got 20 hours. You're going to tell me you can't apply 20 hours and try to be somebody? You all say you want to make money, but you got to apply yourself. You think everybody got to where we're at by just doing nothing? No, they failed. They came across endeavors and they passed them. You know what I'm saying? It's not going to be easy. But with that being said, I'm going to go ahead and bring up Coach Young.
Nice job, Fred. Very good. Okay, listen, so that was a lot of stuff. You heard every one of them get up and say, all right, you're overloaded. We don't think you're overloaded. We get you an education. Sir, Andrew, your name is, right? What company do you work with?
State Farm.
State Farm. Are you restricted?
I am.
Okay,
I think I am.
I think you are too.
Yeah, I think I am.
Okay, you're very restricted. Does that feel good or bad?
Not bad.
How many of you want to be restricted in this room? Raise your hands. Andrew, let me do it again. Is restricted good or bad?
Good.
All right. I thought you said. See, you don't mind me busting your beans, do you?
No.
I'm going to do it anyway. All right, so here we go. Okay, and we like to have fun with it because you got to learn business, and what we do is teach you business. And what they didn't mention, there's a couple things. One, all of our guests, we're going to ask you to fill out a little questionnaire so we get an attitude adjustment, so we know what to do better, and we want to see what you like the best. Fair enough? Second thing we do, we're going to ask you to fill out for your own self. See, life starts with you. Before you recommend anything to anybody, you ought to see what it does for you. Am I right or right about that? Hello, am I right or right?
Right.
Fact. And so, Kayla is, right? Kayla, you know what we do for people? I just picked up his firearms. You see what he has an FIP here? We call them FIPs, Financial Independent Plan. Do you have one? Okay, so I like how everybody can answer that. Not yet. Good answer. Great answer. Everybody ought to have one. Because if you don't, nobody's going to give it to you. And you got to set it up for yourself. And somebody started out with telling them the first lesson I learned from one of the multi-billionaires in this country a great mentor of mine, and he said to me, pay yourself first. I always got that. And I took it literally, because I was a little older than all of you. I was 28 years old when I first saw this. I said, man, does that make sense? Because nobody else is gonna. So I even had to go to my landlord, that was a true story, and go negotiate with my landlord because I was back on my rent. And said, buddy, it's coming, but it ain't today. You can either throw me out or work with me. He did. And guess what? The business paid off. They kept their word. Everything that they said was true. I went to work, paid all the back rent, and then I went from 1,100 square feet to 6,600 square feet. Man, that was a difference. That was pretty cool, too, by the way. Oh, and bought and paid for it, by the way. Cash. How many people know when you got cash or a smash? When you're broke, you're a joke? Raise your hand if you know that. Okay. And everybody, how many people ever had a joke once in a while? Okay, so you've been broke, right? What's the matter with you? You said you had 17 million earlier, didn't you? He wanted to brag about it. And one more point. Trey, the way you did it so quick. Here's the deal. Diddy, right? Is it Diddy? Diddy.
Call me Gene.
Okay, Gene. All right. Now, you see what he said? He said this is what happens just on the money. I'm just going to close out. See, because everybody wants the money. Are you willing, Kate, to do what it takes to make the money? You got to learn the language of the business. You can't do this alone. We don't want you talking to anybody alone. And all of you are not coachable. You all say, oh, I'm coachable. Sure you are. You go out of here and you throw up on your loved one. Guess what? I saw how to make 100 grand. I'm in. And they're cynical and skeptical. And here's what happens. Your loved ones steal your dreams and you let them. Because you listen to somebody else. I don't listen to anybody unless they've done it. Does that make sense? I don't go to anybody unless you've already done it and have experience, and I listen to them. I read the books of the people that's proven themselves. That's who I listen to. I don't listen to people that haven't done it. So the guys in the little houses, no thank you. Hello? Well, I like how you all listen to people that don't know what they're talking about. Man! And then you let them steal your dream? You ought to be... Man! Okay? I'm sick of that crap. We're here to wake people up, one family at a time. Am I making sense? Now, why do we respond to the financial services industry? Personally, we didn't know this. We're just like you. We stumbled on it and found out it's the highest paid industry in the world. In the world. So why are you doing anything else? If you're going to get paid, how many people want to get paid big? Okay, you can leave. You gamble. The guy likes to gamble? Okay, he didn't raise his hand. He's like half dead. Okay, but that's all right. So here's the deal. The average client that we deal with invests $300 a month, and pay attention to what I'm telling you. 9 out of 10 people we talk to don't spend any new money out of pocket. We found what we didn't make sure you understood. We free up money for everybody. For instance, Kate, did you get a tax refund check last year? How much? Okay, good. That's a good thing. Did you get a tax refund check last year? How much? About $2,000. How much? Gene?
$3,000.
Negative $3,000. You owe him?
Yeah.
Good job. Give him a round of applause. Awesome job, Kate. See, he's going, what the heck are you talking about? You're going, hey, I got 2,000. Watch. Well, maybe not so it's a good job. We're going to take those classes back. Okay? Because now watch what happened. Watch between the two what happened. When you got your money back, are you excited? Jacked up, right? Party. Am I right or right? You thought it was a party time. Okay, right. Okay, here's my question to you. When they gave you your money, how much interest did they give you on that money? Who just said that? Did I ask you?
I'm sorry.
I'm going to give you a beating. Okay, I know, I get excited too. How much money, how much interest did they give you? Well, he said it right. Let me do it for you. 0. Can you say that?
0.
Okay, do it one more time.
0.
Oh, 0. Don't you know he doesn't like saying 0? That's why I asked him to do it. So you got 0 on your money. How many people think that's a really crappy deal? He gave his money all year round to the government. It was called a refund check, so he overpaid all year. Am I right or right? Right. Then he asked for it back, and they take a few months to get it back to him. Am I right or right? Then you get it back, and you get no interest on it? Who got screwed? What are you excited about? $2,000. How many people think he still didn't get it? He got excited about his money getting back with no interest attached. Now, Gino, boy, now you owed the money. Did they let you pay 0 back to them? Or they charged you interest? How many people know he likes getting screwed? Anybody raise their hand? So he gets screwed for giving him his money, getting no interest. He didn't pay enough, and he got screwed because they charged the money. Boom!
we show people how to break even with zero. Get more money in your paycheck so you can afford an FIP. Am I right, Kate? Makes sense? Cal, I'm sorry. And we have other ways to do it. We show all the ways how to get FIP. We're not trying to have people spend money, but here's the bottom line point, and I'm closing now. Okay, because some of you motivated me, because you said you got excited about making money. Everybody says it, but here's the truth. Trey, you were great at it. And what Paul says all the time. What are you doing about it? Most people don't do enough about it. So, here's what the company does. You pick up 300, sends you $3,000 as a VP.